Today, I wanted to talk about the four biggest issues I see with the $1 trillion wave of commercial real estate loan maturities that's coming up in 2025. And maybe for good measure, I'll throw in a fifth issue that I'm seeing. The first issue that I'm seeing is underwriting. Many loans have net operating incomes or NOIs that are the same or lower than they were previously when the original loan was placed. And now with more stringent underwriting criteria from the lenders, that's impacting the debt service coverage ratio. So some of the lenders before might have been a 120 debt service coverage, and now if they're 130, but the NOI is the same or lower, that can create a situation where the new loan is going to be lower than the previous loan. And that would mean that the borrower has to come in with cash at closing for the refinance. This is making it very difficult. Also, it's making it challenging on acquisitions as well, because then that just means more equity at the closing table, and which we'll get to in a second, lower loan to values. Along the same lines, the second issue that I'm seeing is that interest rates are much higher than they previously were. So before, when we had all-in mortgage rates, before the February 2022 run-up in the Fed interest rate, the Fed funds rate, we were seeing all-in mortgage rates in the 2s, in the 3s, sometimes in the 4s, and now that has completely shifted. And until recently, we were seeing some loans in the 5s, 6s, 7s, and for bridge loans, they could be much higher, 8s, 9s, 10s, 11, 12%. And so what that does is that also puts pressure on the underwriting, because what that does is for the debt service coverage, it makes it so that your debt costs, your principal plus your interest, are much higher than they were previously. And so that lowers your debt service coverage. But if the lenders are putting in debt service coverage constraints that are higher than 120, 125, if they need more cushion in that loan amount, then that's going to bring the loan amounts down, which makes it more difficult for borrowers to get their financing on acquisitions and also on refinances. It makes this wave of maturities very challenging. The third thing that we're seeing, and this is at least a perception, is that there are declining values in certain asset types, certain markets, and whether that's real or perceived, it is happening. That creates an impact. If you get an appraisal back that is lower than what the expectation is of where the property value is, that makes it so that you're going to have a lower loan to value. And that lower LTV is going to mean that you have to bring more cash to the closing table, either for a refinance or an acquisition. But for the wave of maturities that are coming up for the refinances, this could put a lot of loans in maturity default. It could put them in default. It could create a wave of foreclosures down the road. At this point, we don't know exactly how everything will unfold, because over the next few years, there is about $1 trillion of loans in the commercial real estate space that are coming due each year through 2028. And then it starts to taper off a little bit, but it's still a high amount even into 2028, 2029. But those declining values can put an issue on the mortgage, the loan amount that you can achieve. The fourth thing that we are seeing that is an issue in the market with this $1 trillion wave of CRE loans in 2025 is lender stress. Now, the banks, the lenders, there's a lot of money on the sideline, but the lenders are in the driver's seat right now. They know where rates have to be for them to be able to make money. They know what their guidelines are, and they're sticking to those guidelines. There isn't a lot of room when the Fed funds rates are still higher than what it was before. When you were, close to 0% for the Fed funds, and now all of a sudden you're at 4.33, that changes a lot of the situation for the lenders. And so they're being more particular. They're being more, not difficult, but persnickety regarding which loans they accept, what types of properties. And as we've seen across the country after the pandemic, is that the office market is still having lots of stress. There is still a lot being worked through in the office market. Tenants are downsizing, tenants are moving out. We will see some changes over the next couple of years. So I think that leads into the fifth issue, the bonus issue that I'm seeing. And honestly, that's borrower, client, emotion, expectation. The real thing is that we still think things will get better. I mean, in this business, the majority of us are optimists. There's a lot of us that also look at things and, maybe we're realists, but at the same time, a realist has this perception that things have been better. Things will get better. It's going to take longer time to unfold than I think some people are giving the market credit for. None of us are the market. Together we are all the market. We have to see how this all unfolds. But I think that what we're going to see is it's going to take a little bit more time to unfold than we're expecting. I think rates may stay higher for longer. Now, I've been wrong for years, but I do think rates will stay higher for longer in this go around. And even as of last week, the Fed decided to pause on lowering rates. So after a couple of reductions, we're getting a pause right now. There's still some inflation in the market that's concerning. The economy is still doing well. So there's a pause, which means that mortgage rates are going to be higher, which means that some of those other issues related to underwriting, interest rates being higher, values declining, so lower loan to values, and some lender stress is all going to be present in the market for a little bit longer than we all hope for. But those are the 4 big issues in the bonus issue that I'm seeing right now. And if I can help you with your financing, please feel free to DM me, and we can start a conversation and see how I can help you solve your unique needs. Thanks so much.